Joining us now to share his commentary on the day's markets performance is Reko Nare from Anchor Capital. Reko, thanks so much for your time this afternoon. Our focus, yes, has been on tariffs this week, but we also had the Fed minutes, right? And it seems like policymakers are divided when it comes to rate cuts. Inflation slightly above the 2% target and labor market seemingly stable. More reason to keep, those rates on hold. Markets pricing in 2 to 3 cuts, with some expecting a cut even this month. Where are you at when it comes to rate cuts, Reko, considering that Fed Chair Powell is also facing a lot of pressure from President Trump?
Yeah, thanks so much for having me, darling. It's always great to be on the show. Hello to your viewers. I think it's very interesting. You will remember that every quarter, the Federal Reserve, takes out and releases their quarterly projections for GDP and real GDP. They release their quarterly projections for the state of employment and quarterly projections for inflation. But I think what's very interesting, kind of thinking of the backdrop to this, when we started the year, you had the Federal Reserve largely expecting about 2% real GDP. In other words, subtracting the impact of inflation. They had real GDP coming in at 2% for the US in 2025 as a whole. By the time that we got to the March announcement, or rather the March projections, that had been ratcheted down to 1.7%, and now at the end of June, that got then ratcheted down to 1.4%. So essentially, the Fed is seeing the macroeconomic environment, specifically within the US, as being one of a lower growth environment. If you think that the median is somewhere between 3% or 2.8%, we're very much far from the median as far as the Fed's expectations are. When we zoom into expectations as far as interest rates are concerned, if you think about that same June economic projection that I just spoke about, the dot plots basically pointed to the expectation, the median expectation of 2 rate cuts this year. But you will see that the 2 rate cap cut within the Fed is becoming smaller and smaller. So although 2 is the expectation, the number of Fed participants that are actually expecting no cuts in 2025 is actually growing. And I think that speaks to the macroeconomic uncertainty that the trade policy, as far as tariffs are concerned, then speaks to.
Not even 6 months into President Trump's presidency, and we've just been rocked, Reko. Everything seems to be upside down. And this is the kind of environment that many corporates have had to contend with. Just reflecting on, the previous earnings season, where we saw those Q1 numbers coming out, number of companies, pulling their forecasts, changing their forecasts. Second quarter earnings season set to begin in the next week or so. What are your expectations on that front, considering that we are still in an environment of uncertainty?
Yes, I think you've framed it very well. Uncertainty continues to hold markets and hold management teams within the listed equity players. But essentially, if you think of Taoleng, first quarter earnings season, it was largely powered by big tech. Think of the fact that you had an S&P 500 earnings rising by about 12.2% year on year, beating estimates by nearly 8%. But those gains were largely concentrated to the big or mega cap names. The top 6 or top 7 tech giants drove about 30% growth that we saw within the S&P 500 in the first quarter earnings season. So I think largely the expectation is that we'll see once again a largely concentrated earnings print out of the US as we go into the second quarter earnings season. And I think what you'll probably see is mentions of tariff and tariff uncertainty continue to increase. A reminder that you had about 43% of the earnings calls in the first quarter earnings season management's making mention of the fact that there's these growing trade tensions, and as you said at the beginning, many of the management teams either deciding to withdraw or limit guidance. So I think we're going to probably, or most likely, going to see another earnings season that's dominated by that uncertainty, and management teams just coming out and saying, there's a question mark around costs, around supply chains, and around the planning going forward into the rest of the year.
And talking about costs, in particular, looking at the tech sector, Reko, at the beginning of the year, there was, some fears around AI spending when it comes to tech companies, just on the back of what we saw taking place in China with DeepSeek. But it seems like, markets, investors have shrugged that off. We're seeing a pile back into tech stocks. Recently, Nvidia hitting, $4 trillion when it comes to its market value. Are we still positive about that AI boom? And are the fears around, companies doubling down on spending dissipating?
Yeah, look, you have seen some companies, the likes of Microsoft comes front of mind for me. Some companies use the uncertainty around tariffs and the fact that tariffs and global and geopolitical tensions are at the forefront of investors' minds at the moment. Some companies use it as an opportunity to just scale back on their AI spending. And I think you'll probably see that continue in this second quarter earnings season. A lot of guidance that said that, look, you'll probably see a little bit of cutting back on AI spend. But I think investors are, the saying is that investors can only handle one thing at a time, deal with one piece of news or one fact at a time. And I think at the moment, what investors are focusing on is geopolitical tensions, is trade uncertainties. But I think once they look through that, the question mark around the monetization of AI spend and the large capex that's gone into specifically the large tech names, the question mark comes back is show us the money. And I think probably you'll see that being spoken about as well in the second quarter earnings season as we gear up for it.
All right, let's take a look at those, geopolitical issues, those trade risks, and perhaps reflect on how the JSE has been performing. Local markets really proving to be resilient despite those trade risks. I mean, this week we got that announcement from Trump where he said he'd be slapping South Africa with tariffs worth 30%. BRICS-aligned nations could face an additional 10% tariff, but the JSE holding up well, the rand pretty stable. Is that on the back of mainly the metals? I mean, we saw palladium prices up today, we saw platinum prices up today.
Yeah, I think you framed it very well then, Darlene. I think even if we take a step back and think since the beginning of the year, you've got the JSE up about 16% year to date. A big part of that is driven by, as you said, the PGM players, the gold miners, and then, of course, the rand hedges. Think Naspers, Prosus, think Anheuser-Busch. And it's been interesting for me that those are largely ex-South African factors playing a role there. We walked into the year with the expectation that, the resilience of the GNU and the GNU staying together is what's going to push markets forward, but it's actually been ex-SA factors that have kept the boat afloat for the JSE. But then just zooming into your question, you've had surprising resilience despite the tailwinds that we've already spoken about at the beginning. If you think of even today, the all-share index up about 0.7% this morning. Resources bouncing back strongly, about 2.4% after yesterday's dip since kind of the announcement, on the back of the announcement of that 30% reciprocal tariff that South Africa will be experiencing, and a 50% tariff on copper. So I think, as you weigh that, you would think that the SA market would have been a lot more susceptible to that, would have, taken a lot more pain than it did. But even within our currency market, as you said, you've got the rand up about 0.6% today, in a day post a 30% tariff announcement and a 50% commodity tariff announcement. So I'll probably summarize and just say that, look, you've got surprising resilience out of the SA economy and specifically rather out of the SA market. You've got a bounce in equities and currency, even in the midst of these US defined trade tensions that are muddling the outlook at the moment.
All right, let's hit pause on the conversation, Reko. Before we move on to your stock pick, let's take a moment to touch on what your industry peers find interesting.
I'm going for Visa, and on the basis of what Scott's saying, the one thing about Visa, it's ubiquitous. You can go anywhere in the world and use a Visa card, but I think we're going into an area where rates are coming down. We're going to see more, certainly in the US. We're going to see it in continuing in Europe and that. And I'm in the belief that we're going to, not a great growth phase, but we're starting to pull out of some, when we came in introducing the show and going through all the issues that we've gone through from wars, I think we're going to have a much more peaceful second half where people start to spend. So I like Visa. I just think they're very good in the area, in payments area and so on.
I'm going to go local yokel again. I think you can't go more local than Remgro. Go Remgro. No, it's just, I mean, looking at the recent playbook coming from specifically Raynet, one tend to ask the question, couldn't Remgro possibly be next, where we start seeing these assets being sold? We just heard, how the Vodacom, how that merger is now been approved. Discount to NAV still trading at 41%, so that's a very, very wide discount. And when you look at the past 15 years, average discount for Remgro was around about the 22% level. So I do think that the wide discount is still justifying buying into a Remgro. And then it's like that shampoo. It's like a 2-in-1. I mean, you buy one share and you get so many other great companies like Mediclinic, First Rand, Outsurance, RCL, all those things. So yeah, I'm going Remgro.
So Skalk going 2-in-1 with Remgro and David going offshore with Visa. Just your analysis on those counters.
Yeah, first I'll just say I've never heard somebody describe a stock as a 2-in-1 like a shampoo, but that's a good comparison.
We'll take it.
But yeah, I'll take it. Yes, exactly. If I just think about Visa, I agree with Visa. Certainly, positive 13.2% year to date in US dollar terms. We actually hold Visa within our global portfolio. What I do like about Visa is that it does give you this like sort of resilient yet high margin growth. That's of course backed by strong digital payments, and that continues to be a very constructive thematic going forward. Into sort of the kind of real world, speaks to the real world and where we are currently. And I think if you think of Visa, I think one rub that investors might say is that, look, it's trading on a valuation of 27 times forward earnings, which can seem steamy, but I think that premium valuation is largely justified if you think about the fact that it's growing earnings at about 12 to 14%. So happy with Visa. On the Remgro side, also up 13.2%, but this time in rand terms. I think that Maziv deal is certainly changes kind of the game for them. It's going to be accretive to Remgro shareholders. Vodacom is going to likely pay a lower price than the kind of the original 11 times EV to EBITDA, but that certainly boosts value for Remgro. So I think with that backdrop, I think and that deal specifically on the back of that corporate action, I think positive for cash, supporting earnings.
So you like both counters, but they are not your stock pick. Where are you seeing opportunity today, Reko?
Darling, it feels like I come on this show and I keep on pushing the same stock. So I'm going to go back to the SA banks and I'm going to focus specifically on ABSA as I have before. Why do I like ABSA and why do I like specifically SA banks? If you think about the fact that it's trading at a very deep discount to book, despite it's trading at a deep discount to book, but on top of that, it's got this very stable earnings base in the midst of falling bond yields. The sector for me looks fairly oversold here locally, and even in the broader EM. If you compare it to kind of EM peers, the sector certainly looks oversold. It's actually sitting right now, kind of if you think from price to book, it's sitting at sort of near 5-year lows. So for quality asset, I think it's a screaming buy. The dividend yield has come off a little bit over the last 6 months, now at about 8.2%. But I think you look, if the macro concerns persist, then we've got sort of an issue there. But I think if you do see some kind of breakout as far as some type of relief from our macroeconomic issues and risks, then I think it's one to certainly hold as a re-rating. So ABSA for me, ABG on the JSE.
All right, let's leave it there, Reko. Thanks so much for your time and joining us this afternoon. That was Reko Nare from Anchor Capital.